Okay, so today let's focus in on interest rates. I mean, how do you know if you're getting a good deal, right, on a rate or the best possible rate for your situation? And I realize since you're not eating, drinking, breathing interest rates every day like I do, it's pretty tough. I mean, it's pretty tough to make sense of the day-to-day movements out there in mortgage rates and to know exactly what's going on. And this has especially become difficult since the Federal Reserve stopped doing their quantitative easing, their QE program back in 2022, which had kept interest rates artificially low for years, right? And stable, right? Low, stable, not moving as much intraday as they typically do or they have for the past year, almost a year and a half. It's been crazy. So we have major movements in rates even during the same day. So even after triple checking, right, to be sure you're comparing apples to apples rates between different banks, different lenders, you probably have noticed there's still significant discrepancies between them, between you, your friends, neighbors, whatever. So let's see if I can help. Let's talk this through a little bit. Here are a few reasons why rates differ so much. By far, the number one reason you're going to see differences in rates is outdated information. And by outdated information, I'm not talking like weeks old information. I'm talking hours old. If you're looking at rate information from one lender trying to compare it to another lender that's more than a couple hours old, or worse, a day or two old, it won't be accurate. You're not reflecting the same market conditions, so it's going to be totally different. You're not comparing apples to apples. You've got to pay attention to timing. If you want to compare interest rates between lenders, you've got to do it within an hour or two at the most of each other, so that you have accurate information based on current market conditions and what's happening in the market that day. Number two, different lenders offer different rates. So when you're comparing rate information from one specific lender to a broad average that you find online or to a different lender, you might see some variations. I mean, each lender has its own way of building pricing and rates, so just keep that in mind. Depending on the lender there's going to be some differences too. Number three, upfront points. Okay, some rate quotes rely on upfront points. Sometimes they're called discount points if you're looking at the loan estimate or a closing cost worksheet. And those points secure a lower rate. So it's called a permanent rate buy down. So this means you might see a lower rate from one lender compared to another, or a credit union compared to a lender, or what have you, but it may come with additional point costs to get there that you may not have noticed. So you got to pay attention to that. And that is reflected in what's called the APR, the annual percentage rate. APR takes into account a number of the fees, including points, and recalculates that as an interest rate figure so you can compare, theoretically. You're supposed to be able to easily compare between banks and lenders what their total cost is based on APR. And APR is always going to be higher than your actual note rate that you're paying your payment on because it's including this factor of points and other fees. Okay, so that's another reason. The fourth reason there may be differences is loan level price adjustments. Those are based on certain loan characteristics, and these adjustments can affect the rates you see. So there's loan level price adjustments, based on credit score, for example, based on loan to value, how much down payment you have, and there's other factors in there as well. So that loan level price adjustment affects the overall grid of rates that are built up from there based on how each individual lender and bank want to build it from their four margins. Bottom line is, based on combining all these factors, it's really not uncommon to hear that rates are 1.5% to 1.5% higher or lower for what seems like the exact same scenario. So it's really critical to account for as many variables as possible and try to make comparisons in as short a time frame as possible. I think that's the biggest thing. And then make sure you understand what you're looking at as far as points and fees. Anyway, the bond market swings pretty wildly, and it has been a very wild ride over the past since spring of 2022. It goes up and down some days, intraday as well. Because of that, forget about the rate itself. This is my advice, and focus on the day-to-day movement or the hour-to-hour movement. So, for example, if a top-tier 30-year fixed rate index you find online suggests that lenders are quoting an average of 6.625% today on near perfect loans with no price adjustments, and this is just an example, I'm not saying they're quoting that today, someone with a more average credit score and a different down payment scenario could easily be seeing a rate of 7% or higher. So just keep in mind, any scenario at any lender is more likely to move similarly to another scenario at a different lender, depending on the bond market conditions at any given moment. So to help kind of cut through some of this confusion, what I do is I regularly record rate updates, which I post on YouTube, and they explain weekly the Universal Mortgage-Backed Securities daily chart, so you can have a better idea of how long-term mortgage rates are moving based on hourly fluctuations and daily fluctuations in the bond market, which is all based a lot on economic news. So feel free to watch those videos. That'll help you get a feel of just how volatile the mortgage rate market really is day to day, but also give you a feel for kind of when it's appropriate to lock an interest rate, what the outlook is long-term and short-term, and this could be helpful to you in your decisions and what you're trying to do to buy a home. So just being a smart consumer, means understanding these nuances of rates and how rates are determined on individual qualifying basis, and remembering the bond market is extremely volatile. So don't forget, what we want to do is focus on the day-to-day movement rather than the actual rate itself. As always, if you found this video helpful, please make sure to hit the like button and subscribe to my channel for frequent updates on mortgage rates. Feel free to leave any questions or comments down below, and don't forget to follow me on Instagram for some great reels about mortgage and money related topics. Thanks for watching.